today's webinar, where we will present our Sustainable Finance in Europe and Luxembourg 2025 study. We've had over 400 registrations for this session, which really highlights just how important this topic has become. Sustainable finance is no longer niche. It's now a strategic priority and a key driver of economic transformation, not only across Europe, but globally. In today's session, we'll walk you through the current landscape at the global, European and Luxembourg levels, covering both public and private market funds. Now, you might be wondering what led us to conduct the study. So let me briefly share a few of the main drivers behind it. First, we have the regulatory and political landscape, which is evolving rapidly. We're seeing significant developments from the European Commission's Omnibus Simplification Package to the proposed SFDR 2.0, alongside increasing supervisory expectations. Second, climate and nature-related risks continue to intensify. This makes it more important than ever to rely on robust, credible data to properly assess and manage these challenges. Third, market expectations are shifting quickly. Investors are looking for clearer, more reliable insights to help them navigate what is becoming an increasingly complex environment. And finally, Luxembourg has a key role to play. As a leading hub for sustainable finance across both public and private market funds, it is well positioned to drive progress and help shape the future of the industry. Now, let me also put this study briefly into context. This is something that did not appear overnight. It builds on several years of work. Since 2022, the LFSI and PwC have been developing a fact-based view of sustainable finance trends, with each edition expanding the scope and depth of the analysis. At the same time, ALFI has been contributing with its European Sustainable Investment Fund study since 2021, bringing a detailed perspective on the European fund landscape. Now, what makes this edition, the 2025 edition, different is that it brings these efforts together. For the first time, LFSI and ALFI have joined forces with the support of PwC Luxembourg to produce one single study. And with that, it is my pleasure to hand over to Lorenzo Avico from the LFSI, who will walk you through the methodology behind the research, after which Lorenzo will interview Geoffroy Marcasolini from PwC about the key findings. Enjoy this webinar, and over to you, Lorenzo.
Thank you very much for the introduction, Britta. Good morning, everyone. My name is Lorenzo Avico. I'm the Deputy CEO at the Luxembourg Sustainable Finance Initiative. So before we get to the findings of the study, I would like to spend a few minutes on the methodology. And let me explain what we did, what we included, and what we deliberately left out. The study covers the period from the end of 2020 to the end of 2025 for public markets fund, and from 2020 to 2024 for private markets fund, a time span which allows us to identify genuine trends rather than point-in-time snapshots. It covers sustainable funds at 3 levels: global, European, and Luxembourg, and it spans both public markets funds and private assets funds. To do this, we combine data from 3 sources: Morningstar for public market funds, and Preqin combined with Monterey Insight for private assets fund. On the public market side, we applied 3 important filters to ensure the integrity of the data. First of all, we included only open-ended funds and ETFs, excluding closed-ended funds. Second, we excluded feeder funds and fund of funds, specifically to avoid double counting of assets. And third, we excluded money market funds. For European statistics, our scope covers funds domiciled in the EU 27 countries, as well as Switzerland, Liechtenstein, Norway, and the United Kingdom. Now, And this is a point that I want to flag very clearly, because it matters for how you interpret what follows. Our definition of sustainable investment product is based on Morningstar classification framework. And under this definition, a fund is only considered sustainable if sustainability, impact, or ESG factors are described as a primary focus in the fund's prospectus or other regulatory documents. The fund must either claim a sustainability objective or apply binding ESG criteria to its investment selection. This means that funds which simply mention ESG in a non-binding way or apply only limited exclusions are not classified as sustainable in this study. On the private market side, the methodology is more complex, as you might know, because the data landscape is significantly less standardized. For global and European private assets, we use Preqin, which identifies ESG funds by analyzing fund prospectuses, self-reported data from GPs, and direct general partners engagement. For Luxembourg specifically, we use Monterey Insights as our baseline, and we manually screened approximately 8,500 private asset funds domiciled in Luxembourg, which is a significant analytical undertaking, and for this I want to acknowledge the work that went into it. We screened all funds disclosing under Article 8 and Article 9 of the SFDR, as well as funds that were reclassified to Article 6 in 2024, having previously disclosed under Article 8 or 9. With that foundation in place, let's now turn to what the data actually tells us. And for this, I'm delighted to have here today Geoffroy Marchesoli, partner at PwC Luxembourg, to walk you through the key findings of our joint study, Sustainable Finance in Europe and Luxembourg 2025. Rather than a traditional presentation, we thought we'd do this as a conversation. Due to time constraints, we won't have time for a Q&A session, but we have collected some questions from registered participants, and therefore we'll be able to answer to a couple of them. So let's dive straight in, Geoffroy. This study arrives at the time of significant EU regulatory change, escalating geopolitical tensions, and increasing macroeconomic volatility. Against this backdrop, what does data tell us about the trajectory of sustainable public market funds globally since 2020, Geoffroy?
Thank you, Lorenzo, for the question, and good morning, everyone. I think indeed the study came at a very interesting time. And what we can see from the evolution of public market funds from 20 to 2025, where there have been, if you look back, a number of geopolitical shocks, which started in 2020 with the outbreak of COVID-19, followed by, in March 2022, the invasion of Ukraine by Russia. And then since 2023, the rising tension in the Middle East. Despite all of these shocks, sustainable public market funds have shown a remarkable resilience and have continued to grow steadily rather than retreat during this period. If you look at the figures at the global level, the sustainable public market funds have more than doubled since 2020, and they have grown also faster than what we classified in this study as the conventional funds. Just to put this into perspective, sustainable public market funds grew at a compound annual growth rate of 12.5% during the period, compared to 8.7% for their conventional counterparts, which demonstrate that the growth of sustainable public market funds is not solely driven by, an overall, increase of asset under management, but by deliberate increased allocation to sustainable public market funds by institutional and retail investors across the globe.
Thank you very much, Geoffroy. So, as you say, the global picture is one of continued growth despite the headwinds. But we know that this growth is not evenly distributed. And Europe clearly stands out as the global leader in sustainable investing. Can you walk us through the key figures and tell us what happened in 2025 that marks a break for the trend we have seen in previous years?
First, if you look at the chart, which is on the right, on the previous slide, what I think was interesting is to see that indeed Europe is by far the leader in sustainable public market funds, with close to 20% of its assets under management which are allocated to sustainable public market funds, compared to very much lower figures in other parts of the world, the highest percentage being 2.5% for APAC. I think in Europe, this growth was, whether we agree or not on all of the concept of SFDR, but was largely driven by the introduction of SFDR in 2021. And if you move to the next slide, you will see, the figures in more detail, which has pushed more transparency and an uptake, into sustainable products across the markets. Indeed, 2024 and 2025 mark breaks, in global trends. What we see is that the US saw a slowdown driven by, and I'm going to say it nicely, shifting political priorities, and also, a growing anti-ESG sentiment. While in Europe, sustainable finance and the allocation to sustainable public market funds continue to expand, which, demonstrated a certain divergence between the trends at European versus the other level. A region which, in my view, Lorenzo, will be interesting to watch over time as we will continue to work on this study is APAC. We saw earlier that the allocation or the proportion of sustainable public market funds in APAC was only 2.5% at the moment. But what we see is growing, regulatory interest and also market developments, which in my view will lead to a growth of APAC as probably the second region for sustainable public and sustainable private market funds over time.
Great, thanks a lot, Geoffroy. So that's a very telling picture for Europe, which is the leader in sustainable finance globally. Now, for many of people joining today, the key question may be, where does Luxembourg stand in all of these? And what are the headline numbers that confirms Luxembourg position in the European Sustainable Public Market Fund landscape? And did you find anything that sets Luxembourg apart from the broader European trend in 2025?
I think, Lorenzo, it's the time where we should all be proud. Luxembourg is, by far the leader for sustainable public market funds, with over 800 billion of assets under management allocated to sustainable public market funds. And this accounts for more than 30% of the overall European assets under management in sustainable public market funds. If you look at the SFDR figures, not the sustainable public markets definition from Morningstar, but the funds that are reporting under Article 8 or Article 9, in Luxembourg, there are more than 3 trillion of assets under management at the end of 2025. And this represents even a higher percentage compared to European figures. It's 44% of the funds in Europe that are disclosing under Article 8 or Article 9 are domiciled in Luxembourg. And when you compare, something which I think is also interesting to look at is the proportion of funds which are either considered as sustainable public market funds or disclosing under Article 8 or 9 compared to the conventional funds or the Article 6. The proportion of funds sustainable or disclosing under Article 8 or 9 is much higher in Luxembourg than it is in the other major European domicile, including Ireland, the second, fund domicile in Europe. So, in my view, this really demonstrates the leadership of Luxembourg. And now, if I move to your final question on the 2025 figures, something which really strike me is that in 2025, not only Luxembourg maintained its leadership in Europe, but it also strengthened its dominance, because Luxembourg was one of the only domicile in Europe to continue to attract capital into sustainable public market funds, despite all of the geopolitical tensions I mentioned earlier, which in my view demonstrates that the Luxembourg market is one of the most resilient, if not the most resilient, in terms of sustainability compared to its peers in Europe.
Thanks a lot, Geoffroy. So the numbers that you just mentioned clearly confirm Luxembourg's leadership, but I think that maybe our audience could also be interested in what sits behind those numbers and how these funds actually implement sustainability through exclusion policies, sectors screened out, or the number of exclusions applied. And what did you find when you look under the hood of the more than 2,300 Luxembourg Sustainable Public Market Funds?
First of all, I kudos to the team, who did this amazing job of, looking into the exclusion policies of all of these funds. That was, really a heavy work. But I think the result is worth it. Everyone who works on sustainability know that asset managers are implementing certain exclusion policies. But what we did not expect is to see that nearly half of the sustainable public market funds are excluding between 7 and 10 different industry sectors, which is a very high number, much higher than at least what I anticipated myself. And the reality might even be, higher than that, because what we know is that the research was done based on public information that you can find mostly on the prospectus of these funds. But we know that sometimes there are additional exclusions that are implemented by these asset managers without including them explicitly in the prospectus. So that was for the number of sectors that are excluded. Now, if you move to the chart, which is on the right part of the slide, something which is also very interesting in my view is looking at what are the actual sectors that are excluded by these asset managers. And there is no surprise, according to me. What we see is that the sectors which are the most frequently excluded are the sectors which are also included in the exclusion from the Paris-aligned benchmark and the climate transition benchmark. And as you may know, these exclusions are required as part of the ESMA guideline on fund names, which have been introduced for new funds in November 2024 and for existing funds in May 2025. So you see an alignment between the regulatory requirements on one hand and the market practice on the other hand. And the last thing I wanted to say here is, of course, related to the defense sector. There have been this, in my view, misconception that sustainable funds cannot finance the defense sector. What you can see here is that indeed there are some exclusions related to the defense sector, and controversial weapon is the sector or the most frequent exclusion. However, broader exclusion of other, military hardware is less frequent, and we even see as a trend at the moment a number of very large asset managers that are adapting or updating, if you want, their exclusion policy to ensure that they can finance the defense sector while still keeping, a red line, which is, as you can imagine, the financing of companies that are manufacturing controversial weapons.
Many thanks, Geoffroy. So I think that we have had a very comprehensive view of what happened for public market funds. You already also touched the SFDR lens. So I think that we can move to a part of the study which makes the study itself unique, and is the fact of covering private markets. And here I think the numbers are quite remarkable. In fact, the private market chapter is perhaps the most eye-opening part of the study. Can you share with us the key figures on sustainable private market funds in Luxembourg in terms of size, growth, and how they compare to the rest of Europe?
Yeah, sure. And fully agree with you. That part is probably one of the most interesting part of the survey. If you remember what I said earlier, I said that 800 billion of assets under management are invested in Luxembourg in sustainable public market funds. Now, if we mention the number in sustainable private market funds, that number at the end of 2024, not at the end of 2025, at the end of 2024 is already 855 billion of assets under management, which shows that by now, the proportion or the number of assets under management allocated to sustainable private market funds in Luxembourg exceeded the proportion of assets under management allocated to sustainable public market funds. During the period from 2020 to 2024, and if you can move to the next slide, please. What we can see is that sustainable private market funds grew at a very impressive compound annual growth rate, and you can see it on the slide, of 45.6%. And something which is even more impressive outside of this amazing growth is that Luxembourg alone represents 77% of the overall European assets under management in sustainable private market funds. And Luxembourg is dominating across all asset classes. So across private equity, private debt, infrastructure, and of course, real estate. And I think we should all be very proud of this. And if you ask me, what is the secret sauce of Luxembourg? I think one of the most critical elements, in addition to having the right vehicles to accommodate these strategies, is also the depth and the expertise of the industry. It all starts with a regulator that understands this product. And then, it's the whole ecosystem from the law firms, the administrator, the depository bank, the third-party IFMs. I need to mention the auditors as well. And all of this, supported by industry associations like ALFI and of course, initiatives like LSFI, have allowed Luxembourg to take, that dominating position.
And I couldn't agree more on the importance of the ecosystem here in Luxembourg. The numbers that you talked about are really striking. Let's go one level deeper into the composition of these private market funds. Could you please break down how sustainable private market funds in Luxembourg are distributed, and what the rapid growth of infrastructure tells us about the role of private capital in financing the energy transition?
Well, first, it's important to bear in mind that we have seen an impressive growth across all asset classes, real estate, private debt, infrastructure, and private equity. But it's also true to say that there are two asset classes which outperform the others. And these two asset classes are infrastructure and private equity. And during the period from 2024, they both grew at a compound annual growth rate of over 50%. Now, there are a number of explanations as to why real estate or private debt are slightly lagging behind. First, if we focus on real estate was, the most mature asset class in terms of sustainability in 2020 compared to the other asset classes. And the growth of real estate has been impacted as a result of the rising inflation, which started in 2022. And now, if we focus on private debt, while we see, a number of sustainable products that, in private debt, there are obviously, some further challenges to implement sustainability strategies within private debt. Now, back to your final question with regards to the growth of infrastructure and more particularly, renewable and energy transition. As you can see, from the slide, energy transition is now, the second, largest strategy in Luxembourg in terms of asset under management, and grew at a very, impressive pace. I think this is the result of a number of factors. The first one, obviously, is the objective of the EU Commission to decarbonize its economy. But the second one that should not be underestimated, and I mentioned earlier, the various shocks that we experienced during the period from 2020 to 2025. But Europe was, as a continent, and unfortunately still is to a certain extent, one of the part of the world that was, the most dependent on fossil fuel imported from other parts of the world. And the rising energy cost starting in 2022 led to a shift of priorities from both governments and asset owners into renewable. I think that really serve as an eye opening, and everyone realized that we cannot be as dependent as we were from other parts of the world, and that's where we have seen the acceleration of the asset allocation into energy transition.
Thank you very much, Geoffroy. So I look at the time, and we are unfortunately coming toward the end of our conversation. When you step back and look at the full picture, taking into account public and private markets combined, what is the overarching message of the study for asset managers, investors, and policymakers?
First of all, I think the full pictures shows that the sustainability market overall, and when I say overall, I mean globally, but particularly in Europe, showed a strong resilience despite geopolitical shocks and market volatility. And what we see is that despite what we can sometimes read in the press, there is still a strong appetite for investors, both institutional but also retail, to allocate capital, into sustainable products. If we focus again on Europe, we can expect that the transition to SFDR 2.0, which is around the corner or almost around the corner, will be a positive turning point, with a new framework that will be clearer, that will allow better comparability, and potentially be also more credible. We expect further allocation to sustainable products. Yet the number of asset under management allocated to the new categories may be lower than the approximately 50% of asset under management that are disclosing under Article 8 or 9 currently, but that will be with higher ambition and more alignment probably with the Morningstar definition. When you take all of that into account, I think we should be extremely optimistic, and I think the recent shocks serve as a wake-up call for a number of countries which understand that sustainability is also about resilience and it's also about sovereignty. And I mentioned 3 geopolitical shocks earlier: the COVID outbreak, the invasion of Ukraine, and the tension in the Middle East. And if you think of sovereignty, the first one showed us that we need to be less dependent on the supply chain from other countries if we want to protect our citizens. The second demonstrated that we need to be more or less dependent on our defense and our energy. And of course, the third one is again, if not already done, showing that we need more dependency on the energy supply in general.
Many thanks, Geoffroy. And just to wrap up also my side, I think that the title of this year's report, which is Navigating Recalibration, is very appropriate, because it's not navigating decline, it's not navigating crisis, is recalibration. And all the numbers that you showed us really stress the fact that sustainability is easier to stay despite all the headwinds that we are facing. Now, we still have some time to answer some questions we received from the audience. So let's start with the first one. Given the current geopolitical risk in Europe and the Middle East, how to further emphasize on sustainable finance?
I think in my view, and I already briefly mentioned this, but the geopolitical tensions have reinforced and not weakened the case for sustainable finance. It clearly shows that both sustainable public and sustainable private funds should be allocated to sectors which are critical to the autonomy and the sovereignty of EU member states and countries in general. So I see that as a growth opportunity and not at all as a threat to sustainability.
Perfect. Then we have a second one. What is the role of that AI and data platforms play in ESG data and reporting challenges?
That's a very good one, and for all of those who are working in ESG reporting, they know that we are not there yet, particularly into private markets. The data collection, the data assessment, and the reporting remain relatively manual for most of the organizations. However, it is clear that AI will probably help us in the future to address the data gaps that will remain, particularly as a result of the reduced scope of CSRD, and will also help us in ensuring that sustainability reporting can be prepared as quickly as the financial reporting, with the same level of credibility and trust in the report, which I think is, in my view, instrumental if we want to ensure that over time investors continue to allocate capital into sustainable products.
Great. So we have time for a last question from our audience. And this is more on the regulatory side. So as SFDR 2.0 moves from disclosure to evidential compliance, How should Luxembourg AFMs govern fragmented ESG data flows across multiple providers to produce a consistent and auditable evidence trail? And what does the regulator expect to see operationally?
Okay, I'm looking at the time. I see that I have only 2 minutes to respond to this question. I will, make the same recommendation I'm making to all of my clients. Use the time between now and the implementation of SFDR 2.0 to ensure that your processes, your controls, and your governance around sustainability is improved. And one of the risks, in my view, will be to wait for further clarity on what the requirements will exactly be to make investment or continue selling. With requirements, the person who asked the question is right. Probably, more compliance work, the governance and the control in place will be even more important than it is now. So I think it is critical to ensure that any data you are obtaining from either directly a portfolio companies or from a data provider is being assessed with the appropriate level of due diligence, ensuring that you have internally the right expertise to meet all of the regulatory requirements, and also be prepared to respond any question or expectation that will come from the regulator as the regulation will unwrap in the coming months.
Geoffroy, many thanks for your contribution and your precious insights. Many thanks to Britta Born for opening this webinar, and thanks again to the teams at the ALFI, the LSFI, and PwC who were involved in the publication of this study. And of course, thanks to all of you who joined us today. The full study is available for download on the ALFI, PwC, and LSFI website, and we look forward to continuing this conversation with you. And I wish you all a good rest of the day. See you soon.